Hi, welcome to this special episode of Insider Investing. In this episode, I talk to Purav Shah, who's at the founding team at Dezerv and handles our global investing practice. In his previous life, Purav has worked on Wall Street with JP Morgan and UBS, and I've also had the pleasure and privilege of working together very closely with him in my previous life. In this show, we talk about the differences between trading and investing, the interesting story of Rick Guerin, why we should have a pact with ourselves when it comes to our money, and why asset class selection impacts your dreams much more than we think. Hi, Purav. It's good to have you on the Insider Investing show. We've been thinking about doing this for a very long time. I was actually very intrigued when we were actually going through your background and trying to set this up. Uh, we've had very different journeys. You've worked in private banking and managed money for the wealthiest individuals in the United States, and I've done it here in India. And sometimes it's also exciting to understand what are the big differences that you see culturally in how people manage their money. Tell us a little bit about the move from the US to India. How did it happen, and what sort of contrasts did you see with your investors in the US?
Hey Sandeep, super excited to be on this channel and happy to be part of the Deserve journey along with you and Sahil and Vaibhav. So, I started my journey almost 16, 17 years back when I was in the US. And post my grad, I landed up working with some of the big private banking firms in New York. Uh, it was a very exciting time in my career because I was always thrilled to work on Wall Street, and wanted to work for some of the wealthiest clients with Premier Banking. Uh, what was
How far was
really
your office from the bull, from the big bull? How far
from the
was the
big, so
office?
we had multiple offices, Sandeep. We had one on the Avenues of America, which is Sixth Avenue, and then we had our headquarters on the other side of the river in New Jersey.
Hmm.
So we kind of used to hop on, hop off between different offices between New York and New Jersey. But we were not that far, from Midtown to downtown. It wasn't that far actually.
Hmm.
Yeah, but what was interesting about working with some of the premier private banking firms and some of the largest clients was that we work very diligently in terms of preparing for our pitches. So I was on the investment advisory side, and I would, along with the rest of the team members, work for many weeks preparing recommendations for the clients, right? Which involves us talking to several analysts within the firms globally as well, and then you go present the plan to the clients. The meetings go maybe one time, two times. That time Zoom and Google Meet were not really that widely used. In fact, I didn't even know about Zoom that time when I was in the US back 16 years. So it was all personal meetings. And once we met with the clients, and they followed move forward with the recommendations, the journey went pretty smooth from there, because it was whether on a quarterly basis or semi-annually we had touch points, but we really talked more about their goals and aspirations. Like if someone was starting a brand new business, we checked with them if they needed loan or financing needs, right? Or something
Yeah.
as simple as maybe their daughters made it to the soccer team or something, right? These were
Yeah.
very, very fluid and open conversations, and it was less about portfolio, because we would do actually annual reviews. And when I joined these banks, I found out that we were doing annual reviews. I was really surprised that how do we just review with clients on an annual basis? I mean, yeah, they get their statements, they get the quarterly notes, etc. But how do we review the portfolio annual basis? And the simple answer to that was that clients didn't care on a month to month or quarter to quarter, year to date basis. They cared about long term returns. Even when we showed them our performance reporting for the reviews, we looked at 3 or 5 year numbers for returns. It didn't matter what month over month the investment
Wait,
had
you
moved.
wouldn't get calls from clients asking you to talk about the portfolio, what happened in the last week, and how things were, what has changed in the portfolio in the last 1 month and so on. That wouldn't happen.
We would get calls if they had any nervousness in the market, or they wanted to know what really happened. But that didn't really shy them. That really didn't force them to say, okay, let's open my portfolio, let's dissect it, let's see where I'm falling short or where I'm doing better. No, it was more
Hmm.
about just trying to understand what was happening in the market, right? So a good example is that in 2013, when the Fed was consistently increasing interest rates, we call the taper tantrum, and obviously the equity markets were underperforming that time. Yes, clients called us to ask what's going on in the market, and when we explained to them that there's a tightening happening from Fed, which is might be happening too soon, it might be creating pressures on liquidity in the market, they understood. But then they also knew that they were invested for long term, and they didn't want to just look that as a piecemeal or isolated event to make any irrational changes to their portfolio. And Sandeep, when I came to India about 3.5, 4 years back, I was in a completely different environment. When I was working on the product side, always meeting with clients all the time, with you, with other members of the previous firm, uh, there were a lot of touch points with the clients. In fact, forget meeting first the client, but even in terms of our investment review, we looked at it week over week basis, month over month basis. What happened? What were the reasons, etc. And then when it came to client, you had to talk to through them why suddenly certain portfolios were down or certain funds were down on a month over month basis. And the number of calls, I mean, uh, I was able to reach all my clients in the US in annually in a very, very easy fashion without having to really struggle for trying to get on the calendar, because it was probably once a year, right? It made it a lot more simpler for us to do that concise and conversation and review of the portfolios on an annual basis. And there was a stark contrast that when I came to India with
Well, that's
the
interesting to know, because we've always worked in India. I've always worked in India, worked with ultra wealthy clients in India, and this has been probably the nature of the game, that you are actively in touch, you are making tweaks to the portfolio periodically, and you're communicating very, very actively. And possibly it's because of the maturity of the market, also in some sense. In the US, potentially people have been in the money for a longer period of time. Here in India, we're seeing the formal private banking also be around for very, very short period. I would say like barely 2 decades of real private banking that has been happening in India. And but sometimes, when you think about Indian clients, I think it's not also universal. I remember early on when I started my career, there is this place in Bombay. You're probably familiar with it. It's called the Dadar Parsi Colony.
yeah.
And one time I happened to get on a cold call with somebody, and this gentle Parsi old lady agreed to give me time of day, and she agreed to meet me. And when I went to her house, this was literally a two-bedroom apartment, probably had not been sort of refurbished for the last 2 to 3 decades back then. And we got talking about investing. I was asking her, do you invest in mutual funds, do you invest in stocks, etc. And the only thing she told me that she hadn't done anything quite actively, but her dad used to do investing when he was around, and he had made some investments, and they are lying in a cupboard. And she was kind enough to say that, okay, I'll show them to you and you can tell me what we can do of them. And this was the time before really the whole demat boom happened,
Sure.
when or dematting was not compulsory back then. And this just reminds me how old I am. But she brought out those paper shares. This were shares of what was then called Telco, or now Tata Motors, or
Tata Motors.
Tisco, now called Tata Steel. And we just started putting down the numbers on a piece of paper. And I thought something looked amiss to me, so I said, I'll make a note of these things and I'll come back to you in a few days. I went back to office and I actually put down the numbers on an Excel sheet, because what I thought I was making a mistake sitting in front of her was that I was overestimating the value of these shares. But when I put it onto an Excel sheet, I realized that this was worth 24, 25 crores of papers. And
Oh,
literally, like in a small file in a rickety Godrej cupboard, there are these shares worth 25 crores. And I was like, not even sure whether she knew that she had 25 crores worth of stock. And really, possibly the only reason she could make that kind of wealth is because she was not actively looking at it. And to your point, I think, she probably didn't look at it for a couple of years, and whereas your clients in the US would also not look at it for maybe a year or 2 years, till the time you would ping them and say that it's time to do a review.
yeah, so Sandeep, you're absolutely right about this. I think what also made them calmer in terms of their response to several market events was that the trust with the institution, right? So, with whom
Mhm.
you're dealing with, your advisor, the institution, the type of analysts that work behind the scenes for you. You kind of feel that sense of confidence and responsibility that someone has taken for you, and that they really appreciated. So, they knew that someone is working behind the scenes for them, for their money, that they didn't have to constantly keep looking at their portfolios.
Yeah, I think that's an excellent point. I think a lot of times we are forced into a position where we have to analyze things when we do not believe that the person handling our affairs is really up to mark. And
Yeah,
really, therefore, for us at Deserve, it's been very important to ensure that we have strong domain experts actually handling money for our clients. So the team which is handling asset allocation, for example, is have been people who've been doing it for a couple of decades. You, on the other hand, who are handling our global investing practice, have been doing it clearly for more than a few decades. Similarly, private equity, credit evaluation. So having deep expertise, I think, is very critical, and potentially something that Indian wealth managers or people who advise clients on their money have to potentially do and create those ecosystems.
absolutely, Sandeep.
Yeah, and the other thing, Purav, though I now also look at and contrast the time when we were there, we were in private banking, and now when we started in private banking and now, is the amount of information and data which is being thrown at people, right? Today, you have CNBC, Bloomberg, live information, the tickers are scrolling. Every time there's a market fall, all the channels are falling over themselves to pull attention of the user. So you will see terms like bloodbath and blood on the floor, and those kind of terminologies being pulled at you. Then you have social media, which is
Right.
Twitter, and
Yeah.
suddenly now you start getting
Free
updates on
advice.
your feed, yeah, about what is happening to the markets. And then there is WhatsApp, like I have friends in private banking who send me almost hourly updates on what has happened in the markets. And isn't this also in some sense contributing to the extra thinking that clients are being asked to do? Because suddenly you're being put in a position where you're being thrown news at, and you naturally have to react to it, right?
No, absolutely, Sandeep. I agree with you. The rampant access to information today through social media, through news channels, even talking to friends at parties, right?
Hmm.
Discussing your portfolios. It's so funny. I mentioned to you that the other day. Nothing against my the guy who works for me. My driver. But he mentioned that the stock markets are doing fantastic. I mean, that's the comment that he raised. I mean, this is the guy who's not invested in the markets at all, but apparently he gets information from some of his colleagues or whatever, and he mentioned to me that the stock markets are doing great. So this is really that point where, like, everyone gets so much information, whether it's relevant to you or not. And then what happens is, let's talk about it, Sandeep. 15 years back, how many asset classes were there in India today? Right?
Correct.
20 or 15 years back, people talked about real estate, gold, maybe a little bit about equity, and mostly fixed deposit. Today we got more than 9 plus asset classes, thousands of investments. So there is so much information and so much universe that exists today. People are bound to be confused. They don't know what to invest in. And when you just invested for 3 months in something where you heard about it, and then you realize that suddenly something else is doing much better. I mean, let's talk about cryptos as a great example. Like, you
Correct.
just bought your Bitcoin, and suddenly, if Ethereum is up, people are very hesitant. I mean, people are very excited to actually get out of Bitcoin and maybe move to something else, which has just gone up because there's so much information and so many choices available.
Yeah, I agree. And also, like, reacting to those choices is something that you inherently enjoy, right? And I did this piece a few weeks ago, and recently I was also reading James Clear talk about how we are congenitally engineered to react to situations. And probably if you go back to the time of our ancestors, there would be times when we would be in the jungle and we would have to react to the roar of a tiger or the slide of a snake and stuff like that. And you're mentally attuned to constantly being absorbing that information and reacting to it. When it comes to investing, you have to actually control that urge. So it's almost
Mhm.
this primal urge that we have to act, that we have to pull back on to become great investors. We talk about all of these guys like Warren Buffett and Charlie Munger, and the key thing about them is that long term is really long. It's not even like a few years, it's a couple of decades. So how do you think we should think about that? Because here we have this primal urge on one side, and we all know sort of what is right for the long term.
Yeah. And Sandeep, you bring up a great point about Warren Buffett, for example, right? A lot of people think that, oh, yes, he's a very successful businessman, investor who's made ridiculous amount of wealth.
Hmm.
But if you look at the history, most of his wealth did not come in his prime years. It came in the last couple of decades. And when
Yeah,
we talk about long-term investing, Sandeep, in terms of your time horizon, you have to be, in that sense, be very focused, right? Because maybe those returns or that success will come down the road. He didn't think when he started his journey that he's going to be multi-billionaire. He never had that vision, right? That he's going to be multi-billionaire. All he knew was
absolutely.
that he wanted to invest in good stocks for long
Yeah.
term. So
Yeah, absolutely. I think 85% of his wealth, like you hinted at, got created after he was 65, which is the time you would probably retire in India, right? But if you also like think about situations that have been happening around us, we are seeing that the average holding period of a stock in the US markets is down from potentially 12 years to down to like barely 5 months, right?
yeah,
And that is indicative of a fact that people are being encouraged to trade. A lot of it is probably because it's so easy to trade. And on the other side, there is this gamification of instruments or gamification of applications that is happening. And when you talk about Warren Buffett, the one interesting thing read recently is the story of this gentleman called Rick Guerin, who
yes,
was who I didn't know and was the third partner of Warren Buffett and Charlie Munger. He started off with them, started building Berkshire Hathaway, and he was potentially therefore as smart as the other two guys. In fact, Warren says that he was smarter than the two of us. The only difference was that this guy was into trading and margin trading at that. And then
mm,
one time came where his margins probably blew through the roof and he had to put in more money, and he had to sell his Berkshire Hathaway stock to Warren and Charlie Munger.
yeah,
And as they say, rest is history, right? So
rest
this
is history.
trading thing is not really working out for people.
Yeah, no, which is true. I mean, you even take a note from what India's most popular broking house has come out and recently, online broking house has come out and recently said that
Yeah,
less than 1% of the people, traders actually make more money than the fixed deposits. You know,
that's incredible. That's the other way to think about it is 99% of people actually do not make money equal to fixed deposits.
yeah, and where are fixed deposit rates today? So you think about what kind of returns they are making.
Yeah, absolutely.
Yeah.
And the other thing is also, it's not trading is not easy, right? It's not something that you say that, okay, I will, besides my day job, trade in stocks and trade in asset classes, buy and sell debt, etc. It's a full-time commitment, and then it brings a lot of stress. Like I have seen, and you've seen much better than me, people really like go through a hell of a lot of a stress when it comes to their trading positions. Imagine like you're this trader, you're coasting along nicely, and then out of the blue COVID hits, and
Yeah.
before you know it, your portfolio is down 70-80% because it's probably leveraged. And then
Correct.
you're like shoring up margin, figuring out borrowing from your wife and stuff like that. Is this really just worth it if the returns are just not there around it?
Yeah. No, absolutely, and history actually tells you that. See, I completely agree that why traders are in the market, because they have a certain mandate from their investors, right? That they
Hmm.
need to do certain types of strategies, which is why they're in the market. But
Yeah.
at the same time, if you look at the time horizon of what people have bought and held for long term, even if you look at it just before the global financial crisis, and if you held it all the way through the years, you would have still done better than a trader or than a fixed deposit. And that's because market always rewards long term investment, right?
Yeah, I think the fact that compounding is really a wonder, and it's so hard to explain compounding, right? You just only have to experience it. Because when somebody tells you that, this money will grow at the rate of 12%, a lot of people don't get excited with a number of 12%. But the other way of saying it is that your money will double in 6 years. You're like, okay, wait a minute, that sounds like a good idea. If I put 5 lakhs and it'll become 10 lakhs in six
Yeah.
years that's a great return for me. And actually it's really the same thing, right? It's that rule of 72, where you actually see that the return of 12% delivered consistently over a period of time will mean that your money will naturally double. But when it comes to our money, we don't have the that horizon. Like, one thing which you and I discussed, and as parents, about how we think about kids education, right? You and
Yeah.
I both are thinking about how to prepare our kids for that particular university that in the US that we want to send them to. But when it comes to their money, we think very differently.
Correct, correct. And that
Yeah.
is how generally population thinks, right? They plan for all their goals, whether it's wedding, buying a house, or making that foreign trip, whatever they want to do, right? But one thing they don't realize is that for meeting all those goals, you will need to have money waiting for you at that period of time. And so, have you
Yeah.
planned for that, right?
So, what is really this long term thing? Like when you were in the US and you would
Mhm.
ask folks to think about what tenure are they giving you money for, what is like the normal response that you would get from your clients? Like, would people say 1 or 2 years is long term, or would they have like different horizons around what they perceive as being long term?
No, I think for people, long term really meant that something that they didn't have to look at the balances daily, right? That was one of the ways they looked at it.
Yeah.
Long term meant was that when we asked them the question, when we actually were profiling them or trying to get them into the system, and when we go through the different objectives, the two most important questions, Sandeep, we asked them was what was their risk tolerance, meaning how much volatility can they fathom through the years, and also what was the time horizon they were willing to hold their investments. So someone who
Hmm.
was short term had clear objectives that he needed the liquidity, but people when they said long term, for them it meant like a full market cycle, which was like 7+ years basically. That is what long
Wow.
term meant for people generally. That I'm willing to hold my investment 7+ years because that's what means to me long term. That I'm
Yeah.
willing to hold my investments for a full market cycle, and that is how we really,
Oh, that's amazing.
worked with our clients back there.
That's amazing because sometimes we are conditioned to think of long term in a certain way. Like in India, an instrument, or especially on the equity side, becomes long term after 1 year for tax purposes. And
Yeah,
sometimes we conflate that with what is the long term for the portfolio. We end up believing that more than 1 year is long term, whereas, like you said, it's possibly one market cycle or more, and in most cases it's like 7 to 8 years in some cases. And I really love the fact that you said that you would get people to sign on the mandate, because
yeah,
it's almost like a pact that you're creating with yourself. You are saying that I am signing up for staying invested for the long term, and every time I think about the money that I've invested, I think about whether I have crossed that time period or not. And it sort of reminds me of the story of this, Greek story of this guy called Ulysses, who had to tie himself up voluntarily so that he wouldn't get distracted by the sounds of the sirens, and stay focused on getting through the journey. And sometimes I think probably we also need a pact with ourselves as
Sure.
investors.
No, you're absolutely right, Sandeep. So that pact made it very important, and that was the very first foundation of getting the clients indoor, right? We had
Yeah,
to absolutely make sure that they had signed that pact, which was to understand what their risk tolerance was and what for how many years they were willing to hold their investments for with us.
yeah,
That was very important. And when
yeah,
they actually signed that piece of paper, because that time DocuSign was not really in the limelight, but that time when they did sign that piece of paper, they actually made a pact with that, and they
yeah.
most of the times they stuck to those mandates that they signed with us.
Yeah, and the best example, as you once told me, and I didn't come up with this, is marriage is a pact in many ways, right? So I hope Sumi is not listening to this, but the fact is that we are in it. We go through ups and downs, but we are committed to it because we signed up for something right at the very upfront. But the other thing, the other really interesting point that you brought up, Pura, was the fact that for you, long term is that pool of money where you don't need to look at the current value. And
Sure.
that to me is like a very powerful concept. Like you you only therefore look at what you can control, which is the amount of money that you invested in it and the time that you held on to it. As investors, we don't have control on the number it will reflect today morning. Can I get up tomorrow morning and say I want my portfolio to be worth 11 lakhs? Won't happen, right? All I can control is, one, how long can I invest, and secondly, how much will I invest.
That's true. Absolutely.
Yeah,
As you said, there are only two choices available to you when you get into the market and when you get out.
yeah.
Everything else that happens in between, it's completely out of your control. And which is why clients delegate these responsibilities to experts, because they manage the ups and the lows, right?
Yeah, absolutely. And when you talk about experts, Pura, there is this other fact that investing is not only about equities, right? There are
Yeah.
multiple different asset classes, and they perform differently over different points of time.
Sure.
Just talk a little bit about why you think we should have diversified portfolios, because that's the common question that we get. We are on the back of a very strong bull run on the equities market right now. When it comes to my long term money, why shouldn't I just put that all of that into equity and just forget about it? Why should I even care for fixed income, international equity, gold, and other such instruments when I can just probably put it into equities and just sleep over it?
Sure. And also, people always think about equities more because that is what flashes in front of their eyes most
It's
of
a
the
great
times,
point.
right? When you talk
Yeah,
about markets, you just talk
yeah.
about the Sensex, the Nifty, the S&P 500. But what people fail to see is that no two asset classes, when you take bonds or stocks on a year-over-year basis, they perform the same. Let's take a good example of 2018, for example. That was
Mm-hmm.
a bad year because globally, Fed was tightening interest rates very quickly, and
Hmm.
equities underperformed generally globally. And the best
Hmm.
performing asset class was cash, actually, money market instruments. And
Unbelievable.
who would
Yeah,
have thought that
yeah,
cash would be the best performing asset class globally in 2018? You look
yeah,
at 2013, post 2013, after the Fed started tightening, the real estate REITs investments were the best performing asset class for the next 2 years. And this is what happens because we are always in a cycle. Every asset class goes through its own cycle. Equities follows the economic cycle. Bond has its own cycle. Uh,
Hmm.
Currencies are more volatile and more kind of fluid in terms of how they trade basis on demand and supply. So there is constantly always this cycle or cyclical factor that exists for different asset classes, and they
Yeah,
work at their own pace and for their own merits, right? And which is why we always try to look at what correlation exists between these asset classes, right? How they
yeah,
behave with each other. When equities are going higher, most likely your bonds are underperforming. But there will be a year when bonds are overperforming or outperforming, your equities will be underperforming.
yeah. And there's a philosophical point there, right? Because you can't put your dreams or your aspirations on hold just because one asset class, which is equities, didn't do well in a particular year, right? You have
Yeah,
to get to a certain point, and therefore, even with integrated portfolios, the objective that we've had has been to have uncorrelated asset classes in the portfolio so that we are able to deliver performance consistently over a period of time. And that consistency of performance is key to compounding, right? Because it's not important to get 20% return in one year and be down 10% the next year. It's more important to get 10 to 12% consistently on your money for a long period of time, because that's really when the money compounds. The other thing I see is that, sometimes when we go in for very aggressive portfolios or only one asset class type of portfolios,
Hmm.
uh, the volatility or the downside in the portfolio increases significantly, and when that particular asset class is not doing well, and that then causes us to break out of our investing journey. I remember the time of 2008, when really coming on the back of 2004 to 2007, a huge bull run had happened in the markets. uh, Everyone had practically started allocating money only to equities, and at the
Yeah.
bottom of 2008, when the Lehman crisis happened into early 2009, a lot of investors came back and said, Sandeep, I've made the mistake of my life. I will never put money into equities.
Yeah.
Okay.
Yeah.
Because they lost, like, I remember Kotak stock, I think, if I'm not wrong, was down like 90% from, and you think about that, that number just blows your mind. Like, how can a stock like Kotak Mahindra Bank, which is a bank, established, well run, etc., be down 90%? But it was. And then people who lost that money sort of swore to themselves that they will never invest into
Mm.
equities. And then through from 2009, the rally that they missed was
Yeah.
another. So getting the right asset allocation so that you don't lose money more than what you can tolerate is very important, right?
Correct, Sandeep. And as you said, with the mix of bonds and gold in your portfolio, yes, it may not sound too sexy to you, right? You owning bonds or gold, they don't move
Hmm.
much. But when times
You
like
can't talk about it
2008,
at parties. You can't go and say I have a guilt fund in my portfolio, right? So
correct. People don't talk about bitcoins now, not really gold, because they think that's the new gold, according to them. But
yeah,
when you have gold or bonds in your portfolio, when events like 2008 or 2020 happen,
yeah,
when your portfolio is going down, you will that downside you will have in your portfolio will be a lot less than if you were to hold 100% equity. And Sandeep, we also know that if you're down 50% in your equity, it doesn't take 50% to go back up. It takes a lot more than 50% to go back up.
it
So
has to double
having these
to go back up.
exactly.
Yeah,
So, which is why having gold and bonds in your portfolio, it helps you lower that downside. And so that your recovery time to come back to break even is a lot shorter than owning 100% equities. So I love
yeah,
the fact that in IPS we do have, for the most aggressive, we own bonds and gold. I think it's a very smart thing to do.
yeah,
May not
yeah.
sound sexy again, as I said, but I think it's the right thing to do from client's perspective.
But the one thing I struggle about when it comes to our integrated portfolios is that we've gone out of our way to make them completely liquid, right? In the sense that you can exit them at any point.
Yeah.
And whereas on the other side, we see quantum wealth being created when
Hmm.
you can't break out of an instrument very easily. Like, think about real estate, okay?
Sure.
So if you were to just put it on paper, the returns on real estate haven't been exciting. Okay, you'd
Yeah.
probably made like 6, 7, 8%. Even in a city like Bombay, if you for the last 15, 20 years. But the reason people make a lot of money is because it's just so hard to sell a property, right? You just have to find a buyer, then do the process, documentation, etc. Sometimes it falls off in that period, and then when you look at over a 10, 15 year period, you'll say like, oh my god, I made a lot of money. I put in 50 lakhs and become worth 1 crore. Isn't
Yeah.
that exit barrier an important part of the journey?
I think it's a very important part, just knowing at how the investor behavior works as of today, in the
Hmm.
light of the amount of information and options available. I wish there were instruments where you could hold your liquid assets or market assets, but you're not allowed to break them for a long period of time. I always talk to you about the retirement market in the US, which is so vibrant, right?
Yeah,
From the time you get into your work stream, you invest into 401k plans and individual retirement accounts. They are called IRS because they are retirement accounts. And you can't break these until you actually retire. You break them, you got to pay hefty penalty. On top of that, you pay taxes immediately on the entire corpus. So I feel sometimes these having these instruments actually deters you from making those impulsive decisions that you otherwise would have made, thinking that let me just get out of this stock because I've made great money. Let me go to the next one, try to chase that one.
yeah.
These things would not happen then, I would feel.
Yeah, absolutely. And I think, I see this even in a lot of other instruments, especially with fund managers who bring in heavy exit loads. I've
Hmm.
seen like even the ultra wealthy clients not exit out of those instruments. And then when you look at it 5 years later, you're like, oh, I made a lot of money. And the returns per se may not be exciting, but you made a lot of capital simply because you couldn't exit it very easily. And having that like exit barrier in many ways is important. So if we don't have the same things like a Roth IRA or a 401k, potentially we should create that exit barrier in our mind, and break into that piggy bank only if like it's an extreme situation.
Yeah, you're
But
spot on to that. I mean, India does have something similar called EPF, but the returns are, you're everyone gets the same size kind of a fit all, sort of an approach, right?
yeah,
Versus in the foreign countries where you have the retirement plans, they do let you take the risk as per your risk profile, right? So if you want to be 100% equity, you could be
right,
100% equity, which I think
right.
is a fair game because if an investor is willing to take that risk through his retirement, he should be allowed to. I hope that we can create something similar out here in India where we can. Uh,
Hopefully,
you
it's
know,
early days for India, and I'm quite confident that newer mechanisms will emerge for people to manage their money and really get wealthy, meaningfully wealthy. Because you see, a lot of people who've like actually made real wealth uh, are people who either by choice or by default couldn't exit their portfolio and therefore held on to it. I think in some ways, entrepreneurship or working at a startup and getting ESOPs is a part of the same game, right? You're It's not a very liquid asset. You can't buy and sell it, and therefore you're holding it. You continue to work on a day-to-day basis, and then at some point that it became worth quite a lot.
absolutely.
What worries me, therefore, is that right now, on the other hand, is that a lot of us look up to people who we think are wealthy, but actually may not be. And you're suddenly this spate of people giving me advice on social media about what to do with my money, where in
Yeah,
fact we should be looking at people who really lived the game, like Warren Buffett, over a really long period of time.
absolutely. You're spot on with that.
Yeah,
One thing I've learned, if anything, and I made my own mistakes as well when I started my journey in the US. I also tried to be pretty impulsive in the beginning, and tried to cut corners and tried to move between assets and asset classes, tried to make the most because I was a young guy that time, and I wanted to take advantage of what was available out there. And we had so many people to listen to, right? I mean,
yeah,
the firm that I worked at had 900 analysts, so the sky is the limit what you can listen to every day, right?
yeah.
So I made my own mistakes, and I've learned how I've suffered on my returns. But I did actually started following one of the guys, during my early days, and he mentioned one thing was that if you had to look at your portfolio every day, meaning that you were not sleeping at night properly, if you're not having a good night's sleep or something, that means you were not in the right mix. That means there was something wrong either with your understanding or the type of portfolio you were invested in. Both of them were not in sync with each other, and which is what you had to make change to. Either you get your senses back to where it needs to be, or you change your portfolio to where you are able to sleep at night, and you can carry out your day-to-day task, whatever duties you're doing, your job, etc. So that
I
got
love.
me straightened out
Yeah,
actually, and
yeah.
since that time, I've not looked back actually.
Yeah, I love that. I genuinely do believe that there are smart people who invest, but the really smart people invest for the really long term, and that's
Yeah.
potentially what I'm taking away today. Purav, thank you so much. This was a great conversation. Hopefully, in the subsequent episodes of Insider Investing, we'll talk more about different parts of investing, and we'll lean into your global experience. But this has been an amazing conversation. Thank you.
Same here, Sandeep. Thanks so much. I really enjoyed the conversation today.